Welcome to The Scoop, featured by Mortgage Approvals Ottawa. My name is Remy Albiano, and I have Brock Frost with me here.
The Scoop is the name we just made up, so I hope it sticks. Welcome, guys.
Lots of changes in the mortgage industry recently. It's been a month of crazy phone calls, a lot of questions. Most recently, the Bank of Canada announcement of the target rate going down by 0.5. That's a significant reduction, not what we're used to, from 1.75 to 1.25. What does that mean, Brock?
Well, I didn't know you were going to put me on the spot like that, Ronnie. So what does it mean, guys? I'm getting a ton of calls from clients, potential clients asking what it means. It does mean several things. First thing is that when the Bank of Canada does reduce the rate like that, it doesn't necessarily mean the banks follow in exact sequence. Normally, they do reduce the rates. It does take a week, two sometimes to catch up. So we are starting to see some lenders reduce rates. But one thing it's important to know for the clients and the public out there is that it doesn't necessarily mean your rate, though their rates are going to reduce by the same amount as the Bank of Canada. So you might see, for example, TD reduce the rate by 0.15, 0.2, not necessarily the 0.5 that the Bank of Canada reduced. So that's the first kind of information I always tell my clients.
So the last time they made a reduction,
Yeah.
it went by 0.25,
Yep.
and then most banks, except TD, I believe, dropped it by 0.15. So that's exactly what you mean.
Yeah, exactly. So there's a good threshold or a good benchmark if you want to put it. But so clients are always like they're calling you like they're expecting the 0.5 reduction, right?
Yeah.
But it's not. It could be that some lenders might reduce it by 0.5, some might reduce it by less. The next couple of weeks will tell for sure.
And so we're talking about the prime rate, which is established by each individual lender. Most of them follow the Big Five, though, so it's quite standard. But what does it mean for existing mortgages?
Yeah, good point. So if you have an existing mortgage on a fixed rate, it doesn't really mean much for you other than your fixed rate is exactly that. When you decide to take a fixed rate, when you sign your commitment, that rate is locked in for the entire term. You can't have your cake and eat it too in the mortgage world. So however, if you do have a variable rate, obviously it's going to be reduced by the amount that the lender reduces their variable rate.
Yeah.
So that'll be seen in the next week or two, and those reductions are automatic.
Yep.
So I had a client call, do I have to call the bank and tell them? No, the banks are very well aware that they're going to reduce their rate. It's automatic in their system.
Normally, you would get a letter in the mail. The letter would explain to you that your rate is reducing. It would reflect your new payment as well. If you are in a fixed interest rate and you want to explore the option of going into a variable, you may save some money, especially if you got your interest rate like mid or early last year where the rates were high 3%. It could make some sense to you. And with the appreciation in home value, you can actually take advantage of some equity as well. And then
that's a good point. So, you're talking about almost like a convertible rate. So a lot of the major lenders do have convertible rates, which means you can go from a fixed to a variable or a variable to a fixed, penalty free during the term for the remainder of the term. So it doesn't hurt to call your lender and say, what are you going to offer me on the variable? So if you're on a fixed right now, locked in, call them and just say, what would you give me in a variable rate? And see what they say, and you can compare apples and apples.
In this particular market, though, the fix is very aggressive.
It is.
It's still pretty good.
Yeah.
So I don't necessarily recommend you do that unless you want to take some money out.
But again, it's worth that simple phone call. Another point too, I'm getting a lot of calls from clients who have already received a mortgage commitment.
Right.
Their deal has not closed, and they want to know what is going to happen with their rate. And it's a very good point.
Yeah.
So let's just say you had, I'll give you a live deal. I got a call this morning from a client. He's got 2.89, 5-year fix. It's closing on March 10th with Desjardins. So a fixed rate, if Desjardins reduces their fixed rate prior to closing, they will benefit from that reduced rate.
Yes.
It's automatic.
Yeah.
If it's a variable, same thing. Okay. After closing though with a fixed rate, we've already mentioned you're kind of stuck in that rate. So just for those clients out there that do have pending deals, you will benefit from the lower rate. Myself, I closed a mortgage 6 days ago, and I went in to sign. 2 days prior, so about a week ago today, and they had reduced my rate by 0.05 without even me knowledge. It's automatic.
Yeah.
Yeah.
And it's that time of year where rates are dropping. So you'll see multiple drops, and a savvy mortgage broker would try to time the market a little bit to ask the lender at the right time to drop that interest rate, because most of them will only drop it once or twice for you. They won't continuously drop it 5 times. Since
Exactly.
January, they dropped like 10 times.
Yeah.
Right. So timing it is hard, but it could save you some money in the long run. Anything else you want to talk about regarding committed rates?
Talk about a client that has, would it be beneficial right now to refinance? I'm getting a lot of those messages too. So people have equity in their house, they have an existing mortgage.
Yep.
Would it be worth it to break the term to access that equity at possibly a lower rate?
Yes. Because it depends when you got your mortgage and what interest rate you're paying, right? Because right now the 5-year fix is low.
Yeah.
The variable seems to be dropping. We don't know what will happen 8 weeks from now. And you have a lot of money in your home with the recent appreciation.
Exactly.
You can do something with that money. There's a lot of things you can do with it. You can start building a real estate portfolio. And right now is the time to do it because rates are low, houses are increasing in value. So if you can getting a property for a good deal now is almost impossible because of all the bidding wars. But if you can get into a property and they continue to appreciate this way, it's time to do it now considering their interest rates.
Yeah, I agree. I mean, it's you have to compare all factors, right? So I always look at, when a client says, does it make sense to refinance? I'm like, well, depends.
Yeah.
What is the rate you're paying? What's the rate you're going to be paying? What's the penalty to break it?
The penalty
Are
is a
you
big
switching?
one. That's right.
What are you going to do with that money?
Mm-hmm.
So I had a client that just wants to refi and put cash in their bank account. That makes no sense.
No.
Why would you incur legal costs, mortgage penalty to put money in your bank that's not earning interest? But if you're refinancing and there's a penalty and you're using that to buy another investment property, and in this market, huge appreciation, that probably makes sense.
Yep,
so for the viewers out there that have existing mortgages and possibly looking at taking advantage of a lower rate, just do the math. Look at the numbers. Compare apples with apples. Scenario A is your current status quo. Scenario B is what I could do.
Mm-hmm.
And in a lot of cases, it does make sense. In a lot of cases, it doesn't. I had a client call me today. He's got a variable rate with TD at 2.72%, a couple $100,000 in equity. He's not going to get any better rate than that. On a variable with TD, no chance. And the things with him, I said, well, do you need the cash? He's like, well, not really. I said, well, then there's no point. What's the point of incurring more costs, a blended higher rate to get money that you don't need? But if you had, say, $100,000 in credit card and unsecured debt, it would probably make sense.
Right. And you mentioned a really good point about the penalty, because the penalty is going to play a huge factor, especially if you have a mortgage with an existing big bank. Their penalties are normally higher.
Yep.
Right. Like you can pay a lot of money, almost anywhere between 2.5% to 4% of the balance.
It's big.
Okay.
It's big.
Does that make sense to pull money out, even if you're not buying other real estate, but you can pay off some debt?
Yeah.
So you have to take into consideration the interest that you're paying on that unsecured debt at 19, 20%. And then factor that into your total cost when you're refinancing your mortgage. I want to jump into another question and another subject that
I wasn't prepared for all this.
that I think will drive the market even higher. And that's the April 6th qualifying rate change for insured and insurable mortgages. Insured mortgages are mortgages that are insured by the mortgage default companies like CMHC, Genworth, and Canada Guarantee. Insurable, you abide by their guidelines, but you don't pay the premium. Let's talk about that, Brock.
Yeah, so April 6th, there has been a very vague announcement. So on April 6th, they're coming out with changes to the benchmark rate, again, for insured and insurable, as Rami said. It's kind of unclear exactly what that new benchmark is going to be. They have indicated that it's going to be the average of the 2-year market rate plus 2%. So, that's so, I mean, I've called a lot of mortgage agents and lenders that they really don't know what that is. But, if you were looking at, say, again, I could compare TD because I use them a lot. That would be about 2.79%. So the qualifying rate would be reduced to 4.79 from 5.1 right now.
That's right. Yeah.
So even that point doesn't seem like a lot, but that difference in 0.4% allows either A, more people to qualify, or for people to qualify for a higher amount. So you're right. I agree with you on an economic standpoint. It's going to drive the market and the price up even higher because now more people are in the buyer pool or they can pay more money for it.
Right. And early calculations, speculations based on a 4.79 qualification rate, you're probably looking at an increase in purchase power of about 3%.
That's pretty big.
Yeah. So on a 500,000, it's $15,000. But we'll see what happens on April 6th to get the real deal and how it's going to play out. By the way, qualifying rate is not the rate that you're actually getting. It's the rate that you're qualifying for. So if you're getting a 2.79, you have to prove to the lender that you can afford the mortgage at 4.79, but you're still getting that 2.7.
Correct. Contract rate versus qualifying, right? Yeah. Clients always,
Yeah.
they're like, what? I'm paying 5.1? No. That's what you're qualifying on.
Exactly.
Yeah.
We should actually talk about, not now, but eventually talk about the different interest rates that play a factor in your with your mortgage. Is there anything else you want to talk about?
Just to follow up on that April 6th, it's got nothing to do with the uninsured. So there's been no announcement to the qualifying or rules pertaining to uninsured mortgages, which are, again, things over $1 million, 30-year amortization, rental properties, things of that nature.
Yeah, that's a good point.
Yeah. So if you're buying one of those, like if you're buying a rental property or a place in Toronto 1.5, nothing's going to change.
No.
Absolutely nothing. Again, not yet. There's been no announcement to that effect.
Yeah, it's run differently.
Yeah.
That's it for today. Thank you for watching The Scoop by Mortgage Approvals Ottawa. Again, Brock Frost, Rami Albiano. I just mispronounced my own name. Rami Albiano.
I'm so nervous here.
I feel how everybody else feels now.
We'll see you guys next time, I guess.
See you guys next time. Absolutely.
Cheers.